And hello once again to one and all. This is Professional Insights brought to you by the National Referral Network and hosted by those two guys with no hair who are sequestered now in secret locations. At least one of them is. I am. I'm not going to tell anybody where I am because it's an undisclosed location. But we're remote today. And how are you this morning, sir? I hear in Utah it's rather cold.
It is rather cold, and you've been in some secret locations quite often in the last couple of weeks.
Yeah, it's cold here too. I'm not going to say where, but it's cold here too. So we will leave that alone, entirely alone. Yes, we will. So, as you are all aware, we share insights, wisdom, and information that we're confident anybody who ingests this will be able to use somehow, some way in your professional lives and elsewhere. And today, we don't have a guest because our guests at the last minute had to, they had to go solve very big problems, put out fires, whatever,
Big problems.
big problems. Yes, the national debt, maybe. Who knows? Uh, so we thought today we would talk about some of the things that have been present in the investment arena for a long, long time uh, when it comes to how to construct portfolios, how to manage portfolios, how to measure progress, all these kinds of things. Because I think the ground is kind of shifting beneath our feet a little bit, and we want to talk about how investors can orient themselves in what has become kind of a new normal, especially over the last couple of years. So, Mike, what do you think? Where should we start?
I think that's great, Mike. And I don't want to get extremely technical, but there is a process that traditional advisory services use as a diversification.
Yeah.
And so you and I spoke about this a little bit, and I want to kind of set the framework of this traditional asset allocation that people refer to as diversification. What is it? And what does that look
Well,
like?
let's begin at the beginning. It began with something called modern portfolio theory, which really was, it's kind of about 70 years old now, at least its beginnings are, and I won't go way, way back to the beginning, but it's simply the idea that it's the relationship securities have to one another in a portfolio that create the result, create over 90% of the result, rather than things like market timing or stock selection or what was previously believed. You could kind of look at it as a recipe. A recipe is a combination of ingredients in precise quantities, introduced to one another sequentially under kind of a common condition. That's what creates the result of a recipe. So it really is nothing more than that. So you could kind of think of your portfolio as, in effect, a recipe. And it's been believed for a long, long time that all you had to do was just mix it up, have a combination of really three asset classes: stocks, bonds, and cash. You put them together based upon your risk tolerance. If you were younger, you had a more stock heavy portfolio. If you were older, you had a more bond and cash heavy portfolio. And you just sort of set it and forget it. Let it do its thing, let it sort of ride through the peaks and valleys of the markets. Um, what we discovered over the last, especially 20, 25 years, is this approach has its limitations. We're not invalidating it at all. It's still a very, very valid approach. But what we've discovered is that adding additional dimensions, you can't, you in effect, you start there, but you can't end there. Okay. Particularly if you are entering the phase where you're about to start drawing from your investment portfolio, or your IRA, your 401k, what have you, it becomes all the more important to manage risk. And often, and especially as we saw in 2022, safer assets like bonds did not offer the protection that investors were looking for. And that can be very troublesome if you are beginning to take, I don't know, minimum distributions or spend money from what you have. It can add insult to injury. So we've discovered adding additional dimensions to portfolios in the form of other trading styles has become very, very critical.
But how does an investor or how does a client know, Mike? I mean, this is the biggest thing that we always ask our professionals on this call, and I'll ask you this too. Like, if this isn't your lane, right? If this isn't what you do,
Right.
and you've got so much information on Reddit and Facebook from all of these Instagram financial professionals,
Mm-hmm.
how does somebody even know the limitations to that? And how do they know what questions to ask?
Well, I think the first issue you want to address is how much risk are you taking in your portfolio, and number two, how much risk is appropriate. But if I take a step back even further from that, I think you got to ask yourself, what are you actually trying to accomplish? I maintain that most investors want the same thing. I mean, over 95% of investors want the same thing. They want to make the most of what they have, and they want their money to outlive them, because the vast majority of the cases, the money is meant to provide income for the rest of your life. So if you start rather with what are you trying to accomplish? And if it is, in fact, I want to pay myself income for the rest of my life, then if you take a look at how much risk is the level of risk that's in the portfolio appropriate to that result? Sometimes it can be you're taking too much risk. We see this quite often.
Yeah.
Sometimes it could even be that you're taking not enough risk. Maybe you have, I don't know, I've met clients who have vast quantities of what they have in fixed interest or CDs, things like this, and that won't make the money last as long as possible either. So knowing where you stand from a risk perspective is the first step.
Okay. And so with these different layers, and we'll get into this in a second, but you talk about CDs. Now, CDs have a place in somebody's financial plan. Annuities have a place. So we've got a lot of instruments or a lot of tools at our disposal in today's market. How do we layer that in a way we're getting to where we want to go, but we're using a tool that is right for the situation?
Well, let me go back to the issue of risk for a second. So there are risk evaluation tools that are out there. If you work with an advisor, go to your advisor and say, okay, do you have a risk evaluation tool that we can look at so I know where I stand from a risk perspective? Most tools will give you an idea of what you can reasonably expect from with respect to performance and volatility. That's what it's sort of like saying, how on time is my flight going to be, and is there going to be turbulence?
Yeah, but Mike, a lot of those, I've looked at a lot of those risk things. They're really arbitrary. I mean, it's like if you're in your 20s, they automatically just lean you into an aggressive portfolio.
Well, they are.
If you're in your 60s, right? I mean,
I'm talking about tools that are a little bit more enhanced. We use something called Riskalyze. I think a lot of advisors do, but there are others out there. The main the issue is knowing where you stand and whether or not it's appropriate to you. And then once you know that, then how can you go beyond the traditional asset allocation portfolio theory approach, and how can that benefit you? Well, I want to use the example of institutions and I encourage clients all the time to think of themselves as micro institutions. You think about what an institution does, say a pension fund, for example. A pension fund has to keep promises to pension recipients for 40, 50, 60, 70, 75 years and beyond. It's a multi-generational promise. So that fund is managed so they can continuously keep that promise. Every investor out there, especially those who are going to pay themselves retirement income, at least keep that promise to themselves, you're in effect doing the same thing. And I'd argue that approaching it the same way institutions do is perhaps the most appropriate. And institutions don't just use this traditional portfolio theory approach. They have for decades used other management styles layered on top of that approach. For example, they may use a dedicated commodities manager, or they may use a dedicated real estate manager. They may use a dedicated momentum manager. They're adding additional trading styles and dimensions to enhance the idea of diversification. The idea of diversification really is about not putting all your eggs in one basket.
Yeah.
The idea of layering is don't put all your eggs in one basket and have different kinds of baskets. It's as simple
within a particular layer. So you mentioned momentum. So let's just use that as an example. Within that layer of momentum, it could have domestic stocks, it could have foreign, it could have growth. Is that what you're talking about?
Well, I'm talking about essentially there's two different trading styles. There's passive and there's active. And passive is that portfolio theory approach where I've got, say, 40% bonds and 60% stocks, and I just leave it alone and let it do its thing. Active management tends to adapt more dynamically to marketplace conditions. So it might start out as a 60-40 model, but it might vacillate down to maybe a 30 or a 40% exposure to stocks. It may ramp up to a 70 or 75% exposure to stocks, depending upon the marketplace conditions. It's run more dynamically. It uses computer modeling, statistical analysis, other types of analysis to make its trading decisions and to lean this way or that way, depending upon which way the wind's blowing. The idea of combining the two means you're expanding variability. Really, you're casting a wider net from a risk perspective. The long and short of it is, when you're drawing money down, and we do this in a webinar that we do called Sequence of Returns. When you're drawing money down, managing volatility is the most important thing you could possibly be doing, because if you're able to manage volatility effectively, you're able to make money last longer. It's really as simple as that.
So when we start to draw down, a lot of advisors will just always do projections in terms of rainbows and sunshine. But go into that a little bit, Mike, because I don't think a lot of people understand that if the market's going down in terms of the volatility and you're drawing money out, your principal is actually going down faster than you'd like it to. Is that correct?
Well, it is. And I think when you talk about a retirement income projection, which we run a lot, and I would encourage anybody who hasn't had something like that done for them, please do have some kind of proper projection done. Most projections have to consider variability. They have to consider that returns are all over the place and therefore unpredictable. If you're forecasting an average rate of return of 6% on your assets over the remainder of your lifetime, you don't know how that 6% is going to be achieved. So what has to be done, therefore, is the variability has to be randomized. So you have to test for high returns in early years, low returns in later years, then low returns in early years, and kind of flip-flop it all around and switch up the variability in most cases over 1,000 times. That's a proper test, and then express the conclusions as a percentage chance you might run out of money. That's the most reliable way to do such a projection, because you have to account for down markets here. You have to account for the way the market typically behaves, and since it's unknowable, you have to consider all aspects of it.
Interesting, because I've read a lot of articles that when you mention the money needs to last as long as you do, a lot of financial advisors still today only adapt the finances for the man, whereas the man tends to die sooner. So then the woman tends to run out of money.
Well, and that's an interesting point, and it needs to consider longevity. It needs to run out a long, long time. I was reading an article this morning where about half of all Americans who are doing retirement planning are underestimating their longevity. They think they're going to, die somewhere around 78 or whatever, or according to old mortality tables. So they're just not thinking they're going to live very long. And what we're finding is the opposite. We're finding that people are living well into their 80s and sometimes into their 90s. And whenever we do these kinds of projections, we always run them out that far because we have to. We have to make sure that your money outlives you and that you have the best possible chance of that occurring.
Yeah, it's something. I mean, we can certainly go on for this for a long time, but I know we're coming up against our time here, Mike. Any final thoughts on really structuring and helping people get educated and ask better questions?
Well, I think the bottom line is you got to have a financial plan. Financial plans solve for and project this kind of stuff. You have to have a financial plan that you understand and are happy with it. And the centerpiece of that financial plan is knowing whether or not your money is going to outlive you. So you need to know that. You need to know why. You need to know what you can reasonably expect. And you need to know that the investment approach that you're using is right for you, and it gives you the absolute best chance of accomplishing what you want to accomplish.
And when should somebody start?
Start like now. I mean, It's never, yeah. I mean, it doesn't matter how old you are. I mean, having an idea of what the road ahead looks like is always a good thing.
Wonderful. Well, Mike, you be safe in your secret location. For everybody, if you found this video helpful, please like, subscribe, share it with your friends and family. Be aware that we're here every Tuesday with information like this to help you make better decisions, professional insights with professionals. Please click the notification bell to get notified to make sure that you don't miss an episode. If you have any questions, leave them in the comments. If you have a topic that you'd like us to cover with one of our professionals, leave it in the comment. We'll make sure that we get those created. We're always looking for professionals to do these interviews with and create more insights for you. Mike, thank you so much. Appreciate it. And in your secret location, I'll see you here in a little bit.
All right.